where we have addition and disposal of PPE. Yeah, and our main focus here is that we are still using, of course, straight line method and reducing balance method, but the basis is yearly basis. So for yearly basis, what is the most important highlight here is that the full year depreciation will be charged in the year of purchase. So if let's say for the equipment that is going to be purchased here, equipment C, that is in information number 2 here, if you purchase that in year 12, you purchase equipment C 1st of October. Even though you purchase in 1st of October, that was just 3 months until 31st of December, but you will still charge full year depreciation. And there will be no depreciation, none in the year of disposal if you adopt yearly basis, regardless straight line method, regardless reducing balance method. As long as it adopts yearly basis, there is no depreciation for the asset that is being disposed in the year of disposal. So you will see that equipment A is the one that is being disposed, right? Equipment A. So you dispose that on 1st of July, year 12. So for the 1st of July, year 12, what happened is that there will be no depreciation from 1st of January, year 12, until 30th June of 30th June, year 12. Why? This is because of yearly basis. So due to yearly basis, there will be no depreciation in the year of disposal. There is no depreciation in the year of disposal. So prior to the disposal, before disposal, you still have the asset with you for 6 months. However, here there is no depreciation. No depreciation. Why? Because of yearly basis. For the first 6 months, there is no depreciation. So that is the meaning of the word none in the year of disposal. But for the asset that was purchased, even though less than a year, that will be charged full year depreciation. So equipment A is the list of the asset that you have. You have the same thing here, equipment A, equipment B, with the same figure, cost, accumulated depreciation. Bear in mind, equipment A and B is using reducing balance method. Motor vehicle X and Y they are being depreciated using straight line method. And the policy of the business is to provide depreciation as follows. So your equipment, the rate is still 20%, but bear in mind the basis has been changed. Now it is yearly basis. So yearly basis means you are going to charge full year depreciation in the year of purchase or in the year of acquisition, right? When you add more asset to the company, in that particular year, that particular asset being purchased will have to be calculated in terms of the depreciation, but it will be charged full year depreciation, none in the year of the recognition. For motor vehicle, 15% on cost yearly basis. So this is no problem because for motor vehicle that it will not involve any disposal or new asset being purchased. So this is what happened when we say on cost. On cost means there is straight line method. So under straight line method, the depreciation is based on depreciable cost, and depreciable cost is actually cost on the day of purchase minus the residual value. Let us look at the second information. The second information is on the purchase of asset and disposal of asset. So asset being purchased is meaning that asset that you acquired, asset purchase or asset acquired, or asset being added. Yeah, that's why it is called addition. So these are what you call addition. And equipment C, the initial cost, that is the initial cost given, 160,000. It was purchased on 1st of October. So if it's on 1st of October, it was just for 3 months, because from 1st of October until 31st of December, it was just 3 months. And you will have to charge full year depreciation even though it was 3 months. So why full year depreciation? Why? It is because of yearly, yearly. No one is going to respond.
Yearly
Yearly,
basis.
yearly basis. Don't let me talk alone. I got students. Terima kasih. Thank you. Share. Okay, next is for the asset disposal. Pay particular attention on this. The asset was with us from 1st of January until 30th of June. Still with us. Only on 1st of July is that the asset is being derecognized. Asset derecognized or asset being disposed. Sometimes you can dispose asset by donating the asset. You do not want to use the asset, you go and donate. That is also a form of the recognition. You donate, but that becomes your the one that going to be your donation, different treatment. But here we're talking about disposal for cash. The proceed was 95,000. In the previous example, that was example 4, the proceed was 115. But here I have changed the information to become 95. So for this prior year, prior period, that was the period in the year of disposal. This is the year of disposal. This is, I put here, in YOD. What is YOD? Year of disposal. There is no depreciation. The reason is because of yearly basis. For yearly basis, no depreciation. So let's look at the payment. The payment was made by check for the asset being disposed as well as asset being acquired. So you are asked to calculate the depreciation. So we're going to focus on the part that is going to be the disposed equipment, right? Existing equipment and new equipment. Let's start by disposed equipment. Equipment A. For equipment A, for equipment A, there will be no depreciation. No depreciation means the figure is going to be nil. Why do I say nil? Because earlier I've mentioned that there are no depreciation for the asset being disposed in the year of disposal. However, in the prior year, there were disposal of 80,000. So if you look at equipment A, the one here, previous depreciation was 80,000. It was being provided, but I'm talking about the year of disposal, that was year 12. So that equipment A, there is no depreciation. So equipment A, there is no depreciation. Now let us look at equipment B. No depreciation due to the disposal, and that was also because the company is adopting what? Adopting yearly basis. So when you adopt yearly basis, right, there are no okay. Right. Next is the second one, which is existing equipment B. Existing equipment B is the same, no problem, but it is going to be charged for yearly depreciation as well. So you just do as usual. Yeah, you just do as usual. And this is equipment B that is not disposed. Not disposed. The one being disposed is equipment A. So this is not disposed. So for this one, it would be how much? You will have to calculate. So let me just show you the one here, which is already done. So you can see here for equipment B, 85,000 minus where is it? Is here. Equipment A and equipment B, we have done that just now. Okay, disposed equipment, no depreciation in the year of disposal. The reason is because yearly basis. So that was equipment A. Equipment A, yearly basis, no depreciation. So equipment A is the one that I label using yellow. Okay. no depreciation. So nil. For equipment B, there are depreciation. Depreciation how much? It would be based on the reducing balance method, which is 85,000 the cost minus accumulated depreciation 17,000 times 20% times 1 year. Existing equipment B was from the previous list. Then you have a new item, which is equipment C. Equipment C is the one here, which is here. Equipment C, the one that you just purchased. The one that you just purchased, equipment C, is this, right? So you will have to provide depreciation, but that will be provided based on costs. Why cost? It is the first time that you provide the depreciation. So even though it is the reducing balance method, you will charge depreciation based on costs. Okay. Right. Next is to look, and you can see that I also use 1 year here. So can you see that I include 1 year because I am providing depreciation for 1 year, even though the equipment C was with us for how many months? It was with us just now for just 3 months, right? 3 months, if I'm not mistaken. So even though it was for 3 months, equipment C, which is, I'm going to write something here. Yeah, the asset was with you from 1st of October up until 31st of December, year 12. You have that with you for 3 months. That is only 3 months, but you still charge. That one has to be charged full year depreciation. Why full year depreciation? Because you use use yearly basis. So you have 32,000. So now your figure here would be 45,600. That was for the equipment using yearly basis. You can compare this with the one using monthly basis. Now we go to the straight line method, yearly basis, and this is easy peasy. Why? This one is for motor vehicle X and motor vehicle X is actually the existing motor vehicle. Motor vehicle Y is also the existing motor vehicle. So you just provide depreciation as usual, which is 250,000, 15% for 1 year. No new addition to the motor vehicle. You just have the motor vehicle as it is, so it is still the same 51,000. What makes the difference is this, the new equipment that cause the changes to the depreciation, right? As well as the no depreciation status for the disposed equipment. So these are the two things that cause the changes. The new equipment and the disposed equipment that cause the changes to the way you calculate the depreciation. So the derecognition of equipment A would happen on 1st of July, year 12, derecognition of equipment A. So let us look at some remarks that I put here. The first thing is to eliminate, if you can still recall the lecture on derecognition, video number 8, derecognition of equipment, you would see that the equipment accumulated depreciation has to be eliminated prior to the disposal. So remember, in the current year, we do not provide any depreciation for the equipment A because we use the yearly basis. However, there was previous depreciation of 80,000 that came from the previous year, the 80,000. So that one must be eliminated. For the disposal, this is the disposal proceed of equipment A, and that is 95,000, the disposal here that you receive here. This 95,000, right? So that is the proceed. You will debit bank. And you also needs to remove, so the disposal proceed has been recorded, right? Okay, here, the accumulated depreciation prior to the disposal, this, and then you have the disposal, the cost being disposed. The cost being disposed is the one that you earlier purchased. It was purchased 180,000, right? So this one must be removed. Why? You are selling the asset. Don't just sell it and give the asset physically, but remove all the record. All the record on depreciation is now removed so that the buyer will start providing the depreciation and you, the seller, will stop depreciating. So depreciation ceases here. So for the equipment A. And when that happens, you need to go and remove this 180 and also remove the accumulated depreciation. Why? Because now you receive the money from the buyer for that disposal. So that is where you go and record it here. Equipment, you go and remove. So when you remove, that was the cost that you remove or excluded or eliminated, if you can still recall what I mentioned. And here you would see that the disposal proceed are actually less than the carrying amount. The disposal proceed is less than the carrying amount. How do I know that? You need to do some calculation. So if you look, the disposal proceed, how do we calculate? First, the disposal proceed is 95,000. This one, 95,000. And the cost is 180. 180 is this yellow figure there, 180. Accumulated depreciation was 80,000. 80. So I will put a different color for depreciation then, because it will be confusing. Okay, 80. So you can see that 180 minus 80 is 100,000, right? Are you with me? So remember, carrying amount is actually how much? Is actually 90,000. Disposal proceed was 90. Sorry, carrying amount was 100,000 because 180 minus 80, 100,000. Disposal proceed was 95. Are you looking at what I'm writing?
Yes, madam.
Okay, so you can see a disposal proceeds are less than the carrying amount. That is a loss on disposal, and that was how much? 5,000. So that 5,000 loss will have to be shown as an expense in the SOPL. Expense in the SOPL, right? So that 5,000 is an expense, so it will be shown together with the depreciation. Don't put it under other income. So done with that. A transaction here is that there is a loss. So the disposal proceed, compare them with the carrying amount. Carrying amount is 180 minus 80. So you have carrying amount 100. So the disposal is less than the carrying amount. So there was a loss. Okay, the rest are the same, just like the repetition of what we did, right? For the asset that were being added is the same. Okay. However, for the depreciation, okay, you will see that the depreciation of the equipment will now report a different figure. And the figure that you report here, don't get confused, is the figure from the calculation that you earlier did in your table. This one, 45,600. Okay, the one here is the one that you will have to report later. This will be report in the statement of profit or loss, and that will be under expense. Same goes for this. It will be reported in the statement of profit or loss. It would be under expense, right? Only that this is for the one that we calculated for motor vehicle, and that was 51,000. Okay, these are the presentation, more or less the same like what we have done before this. Only that what makes the difference is the calculation for the depreciation for the equipment. That is what caused the difference. The calculation of depreciation for motor vehicle does not change. And bear in mind, take note on this, the one that you remove here, 80,000, is the one that is accumulated depreciation prior to disposal, meaning that the one in the prior year plus the one in the current year up to the date of up to the date of disposal. But in the current year, for equipment A, remember what we dispose is, just to put in bracket, don't do this in the exam. I'm just doing this to let you know. Equipment A is what you dispose. For equipment A, there is no depreciation in the current year. Why? Because yearly basis. And what was added is equipment C. So what was added was equipment C. What was disposed was equipment A. Equipment A is what was disposed. Equipment C is what was added. Okay. So the rest, the figure here are actually the same as in example 4, 265,340. The concept is still the same, where this 265 is actually coming from this one, 180 plus 180 plus 85 is 265. And 340, that was the first line in your accumulated, in your costs, in your PPE, 340. You will see there was 340, right? That 340 was actually as a result of that 250 plus 90. I'm talking about this, the one here. Same goes for the depreciation at the beginning of the year. This 97,000 would be from the figure that you take from the list of balances that you were given here. This one, 97. 97. If you add this together, you get 97. And the second figure, which is for motor vehicle, yeah, you will have this figure added together, and this figure would be, which is 112,500 plus 13,500. This one would be here, 126, and that was for motor vehicle. So the accumulated depreciation that you remove or excluded or derecognized or you eliminated is the one prior to disposal. It was not 90,000 as in example 4, but this one is 80,000. Since in 2000 or year 12, there are no depreciation because of the yearly basis, and that was also because the asset was being disposed. So we have this figure, 245 minus 62, 600, you have 182,400. The one here, 340, the total, minus 177, you have 163. And if you add up this, you will get this. And this is the one that you will report here, where in your carrying amount. Go and do your what was it, your statement of profit or loss yourself. I don't have the time now, so you can do it yourself, and you can follow what I have explained in example 4. Just be careful, the loss on disposal should be included under admin expenses. The changes would be the figure here and the figure here. These figures would change. 32,450 would change. This one would change. Depreciation motor vehicle won't change. Gain will no longer be there for example 3. Okay, I'm done. Finish off with this. I have finished, right? So I will stop the recording. And also stop recording.